Hello, and welcome to the special year ahead edition of On Point, a podcast series where we explore the post pandemic economy and the biggest themes and events shaping outlook for 2022. I'm John Briggs, Global Head of Desk Strategy, and today I'll be speaking on one of the most critical topics for 2022, which is the shortage of everything in the post pandemic economy. I'm joined by Ross Walker, our Chief UK Economist and Co-Head of Global Economics, Peiqian Liu, our China Chief Economist, Brian Daingerfield, our Co-Head of G10 FX Strategy, and Neil Parker, FX Market Strategist. I'm going to divide this massive topic of shortages into two segments. First is labor, second is goods and inputs into their production. So let's start with labor. And on that, I'm going to turn to Ross. Ross, both the UK and the US have seen a tighter labor market for longer than many initially expected. Are there common causes here, or are there unique differences between the US and the UK that are impacting labor shortages?
Well, the headline data trends are very similar. And we've obviously seen in survey data widespread reports of skill shortages. Often these surveys are running at multi-decade highs. You see some common features, for example, increases in the number of people retiring, perhaps earlier, increases in student numbers. These are typical features that you see during downturns. So in some respects, the data have an air of normality about them, but obviously the speed of and extent of the lockdowns and reopening is playing havoc with these processes. I think that the problems in the UK are probably more acute, and I think certainly you can see two Brexit-related impacts that I would highlight. Firstly, in the UK, there has been quite a dramatic slowdown in the growth of the working age population. Some of that will reflect some of the factors we've just mentioned, people leaving the labour market to retire earlier. But there does seem to be a sizable Brexit-related impact here. And we see in the detail of the UK employment statistics, where you get employment data by nationality, through 2020, there was really quite a dramatic fall in the employment of EU nationals in the UK. And anecdotally, that seems to fit with this idea that many people will have returned to their home countries during the pandemic. Of course, what we don't really have a good handle on yet is how many will return. Probably only a relatively low fraction of the numbers who left, given that post-Brexit, free movement of labour no longer exists between the UK and the EU. So there are, I think, more structural features in the UK. But equally in the US, we've seen some interesting trends. For example, female participation has not recovered to the same degree as male participation. So perhaps there are childcare issues. There's also some more evidence, I think, in the US that ongoing COVID health concerns are maybe holding back some people from returning to the labour market. So it's a more complicated picture than usual. But it does look like these supply impediments are going to persist for longer, and it's a theme I think that will probably run through most of 2022.
So when you say these things are going to last for longer, is there any visibility on when this stuff might ease, or given the complex nature of it, is it just inherently unpredictable?
Yeah, the unprecedented nature of the shock, I think, means this is a difficult thing to forecast. But we've done our own surveys of our client base, and the sort of central case for many firms is that they expect these disruptions and recruitment issues to persist for around a year. The Bank of England's latest forecasts show a similar pattern. They're talking about the end of 2022 before they think some of these skill shortage pressures will begin to alleviate. And that seems to fit as well with looking at sort of macro GDP projections. It probably won't be until the second half of 2022 that you see quarterly growth rates returning to a more normal, sustainable pace as the level of output has normalized. And against that backdrop, you probably start to get, as a follow-through, a more normal, more familiar features in terms of employment demand, employment growth, and labour demand.
Yeah, and there's been similar survey results in the US as well. So when you think about potential tightness in labor markets, both from firms hiring perspectives, but also from a potential wage and inflationary perspective, it does look like a lot of this is going to last through well into next year at least. So that's the labor market side. Shifting to the goods side of things, Peiqian, asking you to unravel and solve for the entire global supply chain, I think, is beyond the reasonable scope of this podcast. But you've looked at a few things specifically. Let's start with semiconductors, which go into so many products nowadays. What did you find? Do you think that chip shortages are going to be relieved anytime soon, or are we looking at a long timeline there also?
Thank you for the question, John. For semiconductor supplies specifically, I think we have to go back a little bit to see that semiconductor supplies have been highly cyclical. In the past decade, we typically experience a semiconductor boom and bust cycle in 3 years. And for the latest cycle of semiconductor supplies, firms began their inventory buildup and investments in 2019, in fact, just before the pandemic hit. So the pandemic-related lockdowns, mainly in early 2020, have put many firms on hold for their investment and inventory build-up plans, leading to a supply shortage. And we're turning back a little bit to demand side as well. We have experienced more explosive demand for semiconductor and its related products because of this permanent shift in work from home demand, as well as we call it a hybrid working model. So the demand for electrical and electronic goods looks here to stay, but we're not ramping up with supplies from this perspective. The good news is that firms, East Asia, which accounts for around 80% of global semiconductor supplies, are now fully up and running, and they are building up production capacity in various locations. But the bad news is that even though the clock is ticking, we still need to be patient to wait for the production to be put into full operation, which probably takes another year or so. So we think that we're probably going to see significant ease in semiconductor supplies well into late 2022 or even early 2023.
All right, so we're starting to hear a lot of late next year type scenarios here across this shortages theme. So it's not just about the goods itself, though, but about the shortage of containers moving them from place to place. What did you find on that subject?
Yes, for the shipping problem, I think it's also a mismatch of demand and supply, but I would like to analyze that from a geographical perspective. Post-pandemic recovery, we have seen much more. We have experienced a much more production side recovery in East Asia, emerging markets broadly even, but a much more stronger recovery in demand side from the developed markets, which resulted demand for goods movement from the emerging markets to the developed countries. Some of the shipping routes are experiencing particularly acute shortages. For example, shipping routes from East Asia, China particularly, to North America, West Coast America's shipping costs have been coming up 10 times that of pre-COVID levels, which means that the shortage has been much more acute than previously expected. So, but we think that the worst might be behind us as more countries are returning to full operations after the pandemic is under control. But we don't really expect any significant easing of shipping costs right below or at the pre-COVID levels. It's more likely that we're going to see more sticky prices, normalization, and we're probably going to settle at a new equilibrium after the pandemic, which is above what we have seen before the pandemic.
All right, we'll save that higher shipping cost note for when I turn to Neil a little bit later. But for the moment, we're going to keep going down the chain here and look at not just, so semiconductors as an example, but in the shipping, but also the input costs themselves. And, here I'm going to turn to Brian. Brian, a lot of commodity prices have been on the rise as well. And there's been, discussions about shortages of a lot of these inputs into production, but in particular, energy, which is both an input cost and then obviously an outright cost to corporations and consumers, which have been rising. What about energy here? Is there any hope that we see some relief on the energy front into or during 2022?
Well, thanks very much, John. So in the near term, unfortunately, I don't think so. I think at the core, there is a supply-demand imbalance that we've been talking about for a lot of goods, and oil is no exception. There has been a voracious and really, a very strong recovery in demand that's been almost resilient to different waves, to new waves of COVID, specifically Delta variant in 2021. Demand for travel has picked up, and we expect in 2022 increased business and international travel demand to continue that trend. And as mentioned throughout this call, the demand for goods and the demand to ship goods and use the fuel involved in shipping those goods is expected to remain quite high. On the supply side, you really have two factors holding down supply from a broad perspective. You have two regions, let's say. You have OPEC, which has been slow playing the recovery in demand really for the duration of the pandemic. We expect that to continue. And then on the other side, you have the US in particular, but developed markets as a whole. Production in the US and developed markets has been very slow to recover back to pre-pandemic levels. And I think there's a capital related issue involved, but there's also it's unavoidable the impacts of the ESG and the push towards more environmentally friendly forms of energy, and how that change in incentives influences the ability of U.S. fossil fuel production to really rise back to, let's call it, the Trump levels of production. So we have supply that's likely going to remain relatively slow to come back online, even as prices are rising. That obviously drives production back. And demand is probably going to stay strong. And I'll add maybe one more point, that all of these shortages feed into each other. There's nothing that's independent as we discuss this. Oil feeds into the shipping shortages. It feeds into goods shortages around the world. But labor shortages also feed into energy market shortages, that getting individuals to work oil rigs is part of this story. And so all of this, I think, is linked together. And so as shortages take longer to normalize, and I think many hope, oil is very much involved in this from both an input and an output perspective.
I like your point there about the interlinkages, because when you tie some of the earlier things we talked about together, in the US, we had port backups in the West Coast. So they moved a lot of those containers to the East Coast, and they couldn't find truck drivers to move the containers. So they got them off the ships, but they've been sitting in ports. So I think it's a very important point about how all of this comes together. But off that, I'm going to turn actually now to Neil Parker for probably the most difficult question of this entire recording, which is, all right, so Neil, you're sitting in the C-suite of your average corporation. You've heard what we just went through, from a corporate perspective. You did chip shortages, product shortages, the shipping, maybe the worst is behind us, but shipping costs probably going to stay sticky. Energy, as Brian just went through. How does one plan or hedge for all this? And from a corporation lens, how do you think about this?
Yeah, the planning, the hedging for a lot of this is not easy for the vast majority of those businesses in a mid-cap space. So not the largest corporations, but equally not the smallest either. Those companies that are the lifeblood of many economies are trying to build more flexibility into their pricing. So they're trying to say, well, look, this is our price, but it's based off of what we're paying for certain raw materials or what we're paying for semi-manufactured product. But of course, by building that flexibility into their own pricing, that's potentially inflationary, because their pricing is going to adjust if these prices continue to remain elevated. They're trying to control better what is controllable, but that's really working around the margins. So there's more dynamic FX hedging that relies less on just spot and forward prices and more on optionality. So again, that gives them the ability to absorb adjustments when they go in the wrong way, but benefit from adjustments when they go in the right way. But as I say, that's probably, you're talking about a few percentage points there that you might be saving when you've seen some of your pricing going up 40, 50, 60% this year. If you look at commodity prices, I think the CRB index is up about 40% year to date. So, that gives you some indication of that they can play at the margin, but eventually they're going to have to put their prices up. Ross, a week or two ago, showed a very interesting graph talking about input price inflation versus output price inflation, and output price inflation in the UK lagging a long way behind input price inflation. So this will have a reckoning at some stage as far as corporates and their adjustments that they will make. But going back to one of the points that was made by Peiqian with regard to containers, the big problem has been actually getting containers, actually getting space on ships rather than the price. Because regardless of the price, a lot of companies are saying they are not being given a clear direction of when the goods will be delivered. And that is a much larger problem, particularly at a very important period for retail across the Western world. So in terms of planning and hedging, there's stuff that has been done, but there's bits and pieces, probably the larger component that they're just having to wear in terms of either reduced margins or higher prices, and that being passed through the price chain. When you sort of put all of that together, their corporate's concern when you speak to them is that what is considered temporary at a central bank level is anything but that. At a corporate level, they're going to have to make these changes. And as a consequence, yes, you might see inflation eventually falling away, but they see it as more a medium-term problem than a short-term problem. They see it lasting well beyond the end of 2022. And I think that it is a different perspective when you speak to a lot of corporates, because they're saying, look, if this lasts 2 years, that's 40% of our 5-year plan. And we're just having to rip those 5-year plans up and start all over again. But equally, they don't like, whilst they don't like inflation, they don't like rate hikes either. They don't like interest rates being tightened and monetary policy being tightened, because they feel that actually exacerbates the problem further. Their funding costs then go up alongside all their other input costs.
Yeah, and I think that's something that, Ross has discussed, and actually is in one of our other podcasts about central bank reaction functions that I know he's concerned about, which is that you've got corporations getting squeezed from various areas. Is this the right time to be on a march towards, much higher inflation rates, even if it is a year-long supply shock driven incentive at least on when it comes to the Bank of England perspective, because it's an incredible challenge, I think, for corporates right now. And then you add in the interest rate side of things, and it just feels like a nearly impossible situation for which to maneuver here in the short term. But I will say that even though it is an incredible challenge, it's one that at least from our side, I know we're going to continue to visit into and through 2022. These are, it's a moving timeline. These are moving timetables, and we're gonna keep looking into it on these subjects and additional ones, because of the wide implications across investor bases, asset managers, corporations, everybody, and especially, probably most importantly, us as consumers. So thank you for listening today, everyone. To get more insight into the year ahead, please navigate to ci.natwest.com/year ahead and follow us on social media. Thank you very much.